I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is June 15th.
And today we're going to be talking about some good stuff. We've got mortgage rates that we'll be talking about. We also have the results of the inflation report and what the feds did. What are median home prices looking like today in metropolitan Phoenix? And what cities are buyers markets versus sellers markets? So let's get into it.
Remember, everyone, this is for informational purposes only. This is not financial advice. And if you like what we're doing here, be sure to subscribe, comment, and like. Give us a call. We'll be happy to help you with any loan scenario you have. We are licensed right here in the state of Arizona. We work primarily with here in Maricopa County, so all the Metro Phoenix cities we are really diving into. But this podcast right now, we're going to go into where are mortgage rates today. This is a national average. It's from the Mortgage News Daily. This is the 30-year fix. We see at 7%. The 15-year fixed conventional loan is at 6.35.
And the 30-year FHA is 6.68. And the 30-year VA, 6.68. VA and FHA will always be very, very similar. And if you talk about this national average, we want to give this to you as a baseline. So our mortgage rates are going to be lower because, again, we're brokers and we have wholesale lenders that have better rates than this. But from a baseline perspective, as you watch our podcasts so you can kind of keep track, that's why we show it.
That's right. And really, rates have increased over the 1 week period since we did our podcast last. So the markets right now.
Wait, what do you mean they increased? Didn't the feds hold the rate today?
Yeah. So we're gonna dive into that and like what's going on with rates. Rates have continually gone up really since April, and you can see what is this? This is the 10-year yield. The 10-year yield is what affects the 30-year fixed mortgage. And of course, a lot more. Most economies will look at the 10-year yield, but the 10-year yield is what, again, moves. It's trading almost every second of every trading day. And it is showing, I drew these lines, and anyone who's been watching the channel for a while, they've seen me draw these lines here. This is a channel. The channel started about November of 2022, and it's been going down. Right now, we are at this resistance point where the 10-year yield, and again, if it busts above this, the 30-year fix is going to continue to go up.
You're talking like a stockbroker, resistance.
Yeah, resistance.
Yeah, I always like that word. It's complex and technical.
Right, right. And just so in simple terms, it's a resistance point. So it means that if it's what potentially holds a price from going any further higher, and support is another point on the bottom. So the bottom line is what we call support. All this is just basic analysis showing it looks like we are right here at this resistance level.
Mm-hmm. Based upon past performance.
Yep.
What is that resistance, and what did you call the other one?
The support.
On the support. Mm-hmm. So the resistance and the support, they're like dotted lines that cars drive in between.
Yeah.
Very rarely do they go out. They can. But
so there's two outcomes. And of course, there's always two outcomes during a day, or during a period of time. It's either up or down. But this is going to be a pivot point. We're going to see either interest rates ricochet down or interest rates bust through this resistance and go up.
Yeah, and when it busts through, it doesn't mean it's going to keep busting through.
Yeah.
But it may go beyond that point, and then there'll be a little correction, then it could come back down. But based upon our support and resistant lines, we call that the interest rate slide.
Yeah.
At least I like to call it that. Are we still in it? Yes, we are still in it, but we're really close to that top part.
I'm kind of betting right now that the rates are going to ricochet and come down. But, we'll see how the economy shakes up, because this was a huge week for the reports of the inflation and the Federal Reserve. Mm-hmm. The inflation report came out on June 13th. That was Tuesday. It cooled the expectations were 4.3% for inflation. And that is the year over year. It's from May 2022 to May 2023. So even though we're in June, we are reporting last month's, inflation.
Right. Yep.
For the last year. And a lot of people don't care about inflation, and I totally get it. It can be very confusing. There's two different types of inflation. One is called just your regular inflation which is everything, and the other is core inflation, which they report. And that is inflation without food and gas. And we've seen that basically the core inflation went down a little bit less than the forecast, but the overall inflation went down a bit more.
A bit more, yeah. And it kind of seems counterintuitive to what our daily lives, make us think, you'd think it'd be the opposite, that there'd be more movement within the core.
Yeah, because it's like the government saying, "Hey, this is good news. Did you know that your food, all your grocery bills and your gas prices have gone down over the last or they have actually improved over year?" And I'm like, "Heck no." I mean, like who does these numbers are ridiculous, right?
Yeah.
Like looking at the grocery, ask yourself, are you paying more today for food than last year or less?
Now, you also talked several podcasts
gas.
ago about how many variables there are. Aren't there there's like a million variables within within these inflation numbers?
Right. There's a lot of variables.
So obviously, to the immediate eye, you may say this doesn't make sense, but this is what is being reported, and this is what the market is reacting to. So a little bit different than we thought, but
I mean, we're right here in Phoenix. I mean, Phoenix, the gas per gallon is about $4 and what do you think, 80 cents right now?
57, yeah.
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 I mean, that's what it was about a year ago.
Unless you have that gas app, you get to save some cents on it.
That's right. In fact, we'll show this on a podcast one day, soon. The gas prices in Arizona are actually very similar to California. We're one of the highest priced states for gas than the Midwest and so on. But we wanted to show you that inflation. Of course, it's affecting everything and all the policies that are being made.
Now, I also want to say this too. The reason why we're talking about such a boring topic is because it has been such a hot topic for so long. The feds have moved rates 10 times in a little over a year, which has not been done in how many years? Is that the 40-year mark?
Oh, yeah.
I mean, 40 years. So when you're wondering, why are these guys talking about this? Because we are in such an anomaly.
Yeah.
So again, we hope that this just simply comes and goes. But right now, it is a reality. So as boring as it is very interesting.
So this just shows you the charts from 2020 to today, just that inflation. I want to show you a quick chart of what Arizona is at for Arizona. So each state has, of course, their own inflation because, all this information is going into the government. And right now we're about, what are we about? A little over 7% on inflation. And again, we hit at a peak at about 13% for our inflation here in Arizona. And that's pretty normal for a city or a state that is we are a high growth state. A lot of stuff's happening in Arizona. So building.
Kind of what you call high octane.
Yeah, it's high octane.
Yeah. We go fast sometimes, we bump into the curbs, but we're, we've got some really good markets, and then we have some not so good markets.
Yeah. So in lower growth, lower volatile markets, in the Midwest, older towns or whatever, you're going to see less inflation typically, but in Arizona, not so much. This is a grid chart showing that, in 2019, we were year over year, we were about 3%, which was pretty typical. 2020, low, but 2022, we saw, gosh, that was
look at those numbers, 10, 11, 12, 13. Is it ever going to stop?
Yeah. So right now we're at 7.4. Well, we only report every couple months. Really, it's not every quarter, but not often.
Yeah.
Is that 6 months? So every other month. So that's in Arizona. Now let's talk briefly on the Federal Reserve meeting that was on June 14th. That was Wednesday, yesterday. Jerome Powell and, of course, the Federal Reserve and the whole committee has decided not to increase interest rates.
Yeah. So yesterday, CPI came out, and that's the first day of the Fed meeting. And then today's the second day at, I think, 2 p.m. Eastern time, they actually make the announcement of what they did with the change. And they did decide to do what they call as a skip. People would go into this meeting wondering, are they going to rise? Are they going to increase rates? Are they going to lower them? Or are they simply going to pause them? Well, they didn't use the word pause. They actually use the word skip, which means, and we'll get into it in just a little bit, but basically, the surprise aspect of this decision was this dot plot. And why don't you speak a little bit about
it? Just means that when they ask all the committee members and the Federal Reserve where they think they call it the terminal federal rate should go to, the forecast is most of those committee members have increased their forecasts. I mean, they really think that we're going to go higher. Right now, we're between 5% and 5.25%, and they're really thinking about 5.6% to be that's what that's what the expectations are. So we could see another maybe 2.25% increases. If you were to ask all the committee members today, that's what they were saying.
Yeah. And they use the word, hawkish versus dovish, hawkish being a little bit more aggressive, tighten things up, push that interest rate up. And then you have the doves that are like, hey, let's just kind of keep things a little bit slow. They have talked about these hawks getting a little bit stronger. So basically, they talk about, the hawkish view and the dovish view. There are a number of these, federal chair, people that have different views. And that's why you have multiple people. Some can be hawkish, which means more aggressive. Get those interest rates up and let's get inflation down. Then there's others that are a bit more dovish, with it a little more soft. Let's let things kind of be. Let's not rock the boat too much. And a lot of people really thought that if they wanted to be hawkish, they would have raised today. But Powell clearly came out and said they're skipping. So I think people were a little surprised at the skip. But what they said, they kind of pushed it out. And they said, we do expect a couple more increases, small increases, maybe a couple 25 basis point pushes between now and the end of the year. Personally, Ed and I are talking, and we think it's a bit like the parent, trying to discipline the child, where they really don't want to discipline the child. They're really hoping that their words do the trick, which is clean your room. And in this case, Powell's saying inflation come down. And if you don't come down, we are going to increase those interest rates.
We think it's a threat. We think it's I think that it's an empty threat. I personally, you and I, it's an empty threat that they won't actually do it, but just their words will scare the market, and they'll get the result they want.
And we were also talking, it's not like they're doing anything wrong. They're just simply doing what they need to do to get this economy as level and as soft of a landing as possible. There's a movie out there, where they say, well, you can't handle the truth. and part of that is, if we actually kind of knew just how important everything was, the market would probably act a lot different. So they want us to keep working, and they're going to, keep these interest rates high, stop, people spending, and hopefully get this inflation thing under control. And then we all look in the rearview mirror, we'll say, wow, actually that was a bit more of a tense time than we thought.
Yeah. So I think that, this is important to Arizona. It's important to our market. What happens in the Fed, inflation and interest rates will affect what housing prices do. And that's what we're going to look at real quick here. Where are we with here in the Metro Phoenix area, all the major cities here? We see the median sales price at $445,000, a little over that. Now it has come up from January 2023. That's where we had there was a high. The very peak is May 2022, came down, hit a low there at January 2023, and we've really rebounded well.
Yeah, look at that. That's a real nice rebound.
Things are really strong for sales prices.
And we don't really get into, the why in this podcast, but again, the inventories are still low.
Very low. We're at 10,400 active homes for sale, and they just continue to come down. Now, the pace of the listings isn't coming down as, the slope isn't as steep as you can see here. We're still seeing declines in the active listings, and really the lower the listing count is, the higher, the more pressure it is to drive those prices up.
Yeah. So we really don't want to see a decline anymore.
Yeah.
We want things to stabilize and start going up.
Yeah. So we've covered this from the Cromford Report many times, that this is the 17 most populous cities in the Metro Phoenix area, and those that are in green have a market index above 100, which means they're technically in a seller's market.
Which basically means that there's more buyers chasing than sellers.
Exactly, and there's Buckeye has a market index of 93, which is, it's close to 100. It's close to balance, but it's really a buyer's market. There's probably less buyers chasing those sellers. So sellers are a little bit more agreeable to maybe concessions or, a price, prices. But anyway, there is another city here, Goodyear, that did see, is one of the 17 cities that is the only city that saw over the last week a little softening where that market index has gone down. And that's what these arrows will show here.
And it's a bit misleading, softening. Look, it's still, a wonderful market for these sellers.
Yeah.
So when we talk about, softening, it is relative. It did come down, but it's still positive.
And overall, here's our contract heat map. This is basically showing you where in the color codes here, we see a bunch of these reds. The red is where we see that's all buyers. Those are like hot buyer markets, markets where the sellers, those are seller markets where there's a lot of buyers chasing fewer sellers.
Yeah, right. That's right. Yeah, this is the brighter the red, the better for the sellers.
Yeah, and I highlighted some yellow areas. There's 2 zip codes right now that we would say are even hot. They're the hottest zip codes in the city right now. It's Phoenix. In Phoenix, there's 85033, 8540. And for probably many different reasons, but there are a lot. Those zip codes are leading for buyer strength. There's very few homes that are not under contract. Most of the homes that are for sale in those zip codes are under contract.
Yeah, and those 2 markets happen to be near, 2 of our universities. Yeah. I wonder if that's...
Oh, yeah, it's true. Yeah, we have Grand Canyon University and right here at 85...
I don't know what zip code
right
it
here
is.
To the west, just north of I-10. And then we have... Chandler and Mesa last week had a couple really hot zip codes, and those have just cooled a little bit. They're still really hot, but there's really only 2 leading zip codes right now. But that's where we're at. We're going to continue to show you these updates. We hope that this is helpful for you to understand where we are in our market and really a full perspective of context with the economy. And we'll, if you have any questions, let us know.
Yeah, let us know. And just, last parting words, everyone just be calm. Everything is happening the way that, the feds are wanting it to. Inflation's a little bit sticky, but I think these interest rates are working and the market is going to stabilize here soon. So that's all positive.
Okay. Be sure to subscribe, comment, and like. Take care, everybody.
Thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.